So you think the only way to get cash out of your crypto is to sell it? That's what most people believe, and it's why they stay stuck. They see their Bitcoin portfolio as a locked box they can't touch until they cash out, pay a massive tax bill, and say goodbye to their position forever. But what if that's a lie? I'm about to show you how savvy investors are pulling tens of thousands of dollars in cash from their Bitcoin right now. We're talking cash for a down payment on a house, cash to jump on a new investment, or just cash to have on hand for a crisis, and they're doing it without selling a single satoshi, without triggering a tax nightmare, and without giving up their stake in Bitcoin's future. This isn't some fantasy. This is the financial blueprint that separates the long-term winners from the people who are forced to sell at the worst possible time. Imagine funding your biggest goals, that car, that business, that house, while your Bitcoin stack keeps working for you in the background, ready to capture every bit of the next bull run. This is the ultimate HODLing live strategy, and you're about to learn exactly how it's done. If you've been around crypto for more than 5 minutes, you've heard the command HODL. Hold on for dear life. It's more than a funny meme, it's a core belief. It's the understanding that Bitcoin is a long-term store of value, digital gold, and that its value is programmed to go up over time. Selling your Bitcoin is treated like a cardinal sin, not just because you lose out on future gains, but because you're trading a pristine hard asset for a fiat currency that's designed to lose value. And let's talk about the immediate pain of selling: taxes. The second you sell your crypto for a profit, you create what the government calls a taxable event. If you've held for over a year, you owe long-term capital gains. But if you've held for less, you get hammered with the short-term rate, which is the same as your income tax. Think about it. You sell $100,000 worth of Bitcoin you bought for $20,000. Depending on where you live and your income, you could be writing a check to the tax man for $12,000 to over $20,000. That's cash you've just set on fire, gone forever. Even worse than the tax bill is the regret. How many people do you know who sold Bitcoin at $1,000 or $10,000 or even $50,000 just to watch it scream to a new all-time high weeks later? That feeling of missing out on life-changing money because you needed cash in the short term is brutal. The never sell philosophy is about avoiding that exact outcome. This leads to a paradox where you might be Bitcoin rich but cash poor. Your net worth statement looks amazing, but you can't actually use any of that wealth without breaking your number one rule and getting slapped with a tax bill. That's the problem we're here to solve. The answer isn't selling. The answer is making your Bitcoin work for you. So, how do you get cash from your Bitcoin without actually selling it? The answer is a strategy that the wealthy have used for centuries with stocks and real estate, now rebuilt for the 21st century: a collateralized loan. The easiest way to picture it is like a digital pawn shop, just with way better terms and no sketchy backrooms. You know how a pawn shop works. You bring in a valuable asset like a Rolex. The pawnbroker looks at it and gives you a cash loan for a fraction of its value. He holds your watch as collateral. You pay back the loan with interest, you get your watch back. You don't pay it back, he keeps the watch. A Bitcoin-backed loan is the exact same idea. You deposit your Bitcoin with a specialized lending company. They secure it as collateral, and in exchange, they wire you US dollars or a stablecoin like USDC. That cash is yours to do whatever you want with. Once you pay back the loan plus interest, you get 100% of your Bitcoin back. Now here's the most important part. Because you never sold your Bitcoin, you never created a taxable event. You just borrowed against it. This is similar to getting a home equity line of credit, or HELOC. When you borrow against your house, you get cash, but you didn't sell your house. You still own it, and you still benefit if it appreciates. The principles are similar here, but it's crucial to remember that crypto loans operate in a different regulatory and risk environment than real estate loans. This is the bridge that solves the Bitcoin rich cash poor problem. It lets you turn your digital wealth into real world buying power without wrecking your long-term investment. You can fund a wedding, start a company, or diversify your investments, all while your original Bitcoin position remains untouched, ready to appreciate. This is the financial tool that used to be reserved for the ultra rich, now available to anyone holding Bitcoin. Okay, let's get into the nuts and bolts. This might sound complex, but it's actually pretty simple once you know the language. Let's walk through it. First, you have to understand these key terms. Collateral. This is simply the asset you're putting up to guarantee the loan. In this case, it's your Bitcoin. This is what the lender can take if you don't pay them back. Loan to value, LTV. This is the single most important number in this whole process. It's the ratio of how much you borrow against how much your collateral is worth. Example, you have $20,000 of Bitcoin. A lender offers you a 50% LTV. That means you can borrow up to $10,000 cash. Your LTV is 50%. $10,000 loan, $20,000 collateral. A lower LTV is always safer. A 25% LTV means you're only borrowing $5,000 against that same $20,000 in Bitcoin. This gives you a massive safety net, which we'll talk about right now. Interest rate, APR. This is just the cost of borrowing the money, shown as a yearly percentage. Rates can be all over the place, from as low as 2.9% to 18.9% or higher. This depends on the platform, your LTV, and often whether you're part of their loyalty program, which might require holding their specific token, adding another layer of risk. Margin call and liquidation. This is the number one risk you have to respect. Bitcoin's price swings wildly, so what happens if your collateral's value plummets? Let's go back to our example. You borrowed $10,000 against $20,000 of BTC, 50% LTV. Bitcoin then crashes and your collateral is suddenly only worth $13,000. Your $10,000 loan is now a much bigger piece of that pie. Your LTV has skyrocketed to about 77%, $10,000, $13,000. This is when you get a margin call. It's a warning shot from the lender telling you to fix the situation. You usually have two choices. Add more collateral, deposit more Bitcoin to bring your LTV back down, pay down the loan, use cash to pay back some of the loan, which also lowers the LTV. If you ignore the margin call and the price keeps falling, you hit liquidation. This is the nightmare scenario. The lender will automatically sell just enough of your Bitcoin at the market bottom to pay themselves back. You get whatever is left, but you were just forced to sell at the worst possible time. This is exactly why starting with a low LTV is non-negotiable for a conservative approach. If you had only borrowed at 25% LTV, $5,000 against $20,000, the price would need to fall off a cliff before you were ever in danger, giving you a huge buffer. Now you know how it works. Let's talk about the two main ways to use these loans. One is conservative for liquidity, the other is aggressive for growth. This is the strategy this video is all about. Getting cash for life without selling your Bitcoin. This is for big moves. House down payment. Instead of selling your stack and taking a huge tax hit, you borrow against it. You get into the real estate market while your Bitcoin keeps its exposure. Starting a business, need capital to get going. A Bitcoin loan can provide that seed money without you having to liquidate your best asset. Paying off high interest debt. If you have credit card debt at 25% APR, taking a Bitcoin loan at 12% to wipe it out is a no-brainer. You lower your interest payment and keep an appreciating asset. Emergencies, medical bills, car repairs, you name it. Cover unexpected costs without a desperate fire sale of your crypto. The power here is tax deferral. The cash you receive is a loan, not income, so in many jurisdictions, it's not immediately taxable. However, and this is critical, tax laws are complex and vary by country and state. You must consult with a qualified tax professional to understand the specific rules for your situation. This strategy gives you flexibility while your Bitcoin's value hopefully continues to grow. Strategy 2, borrowing to buy more Bitcoin, leveraged exposure. This is the advanced high-risk strategy. This is for people with high conviction and a stomach for volatility. You're essentially using debt to increase your Bitcoin position. You start with $20,000 in Bitcoin. You take a $10,000 loan against it, 50% LTV, paying 12% APR. You instantly use that $10,000 cash to buy more Bitcoin. You now control $30,000 worth of Bitcoin, but you only put up $20,000 of your own capital. The upside, if Bitcoin's price rips up by 50%, your total stack is now worth $45,000. That gain completely dwarfs the $200 in interest you owe on the loan. You just use leverage to pour gasoline on your returns. The massive downside, this cuts both ways. If the price of Bitcoin dumps, your losses are also amplified. A 20% drop means you're losing money on your original $20,000 and the $10,000 you bought on loan. This also sends your LTV soaring, putting you on the fast track to a margin call and liquidation. This is not for beginners. If you get this wrong, you can lose more than your initial investment. For most people, strategy 1 is the game changer. It's the key to financial freedom that aligns with a never sell mindset. Picking the right lender is everything. This space has grown up, but not all platforms are built the same. Here's a quick rundown of some of the big players so you know what to look for. Figure Lending, the lowdown. Figure is a heavy hitter, known for being a major lender in the traditional finance world, which gives them a lot of street cred. They are often praised for competitive rates. The terms: they offer a fixed APR, which is huge for predictability. Rates around 9.99% at 50% LTV have been seen, which is very competitive. They offer LTVs up to 75% for those who need more flexibility. The security: Figure promotes its focus on advanced security like multi-party computation, MPC, wallets, which aims to eliminate single points of failure. This is a big deal, but you should always verify their current custody setup directly. Best for people who want low fixed rates and are looking for a platform with a strong focus on security technology. Ledn, the lowdown. Ledn is a Bitcoin first company that earned a ton of respect by surviving the 2022 lending crisis when others like Celsius and BlockFi went bankrupt. Their transparency is their calling card. The terms: they offer standard 12-month loans at a 50% LTV. Their rates can be a bit higher, sometimes around 12.4% to 13.4% once you factor in their admin fee. You can repay anytime without penalty. The security: Ledn uses top-tier custodian BitGo and publicly shares proof of reserves. Critically, for their standard loans, they do not rehypothecate your collateral, meaning they don't lend it out to someone else. This is a massive security plus. Best for Bitcoiners who prioritize transparency, a proven survival record, and the safety of knowing their collateral isn't being gambled with. Nexo, the lowdown. Nexo is one of the biggest and oldest platforms out there, offering a whole ecosystem of crypto products. The terms: Nexo uses a flexible line of credit model so you can draw and repay cash as you need it. Their base APR is high, starting at 18.9%. The catch is you can get that rate down to as low as 2.9%, but only if you become a platinum member by holding a big chunk of your portfolio in their Nexo token and keeping a low LTV. The security: they use institutional custodians. However, it's widely understood that their business model involves rehypothecation to generate yield. This is a trade-off. You get access to low rates and other products, but you take on more counterparty risk. Best for users who want a flexible credit line and are willing to go deep into the platform's loyalty program to get the best rates. Salt Lending, the lowdown. Salt is another OG in the crypto lending game. They focus almost entirely on loans and have survived multiple bear markets. The terms: Salt offers flexible loan terms, usually around 50% LTV. One of their standout features is a stabilization tool that can automatically move your collateral to a stablecoin during a crash to help protect you from liquidation. The security: like Ledn, Salt advertises that they do not rehypothecate collateral, which is a major trust signal for cautious borrowers. Best for borrowers who want a straightforward loan from an experienced platform with innovative risk management tools. Nebeus, the lowdown. Nebeus is a European-based platform known for offering very flexible and high LTV loans. The terms: Nebeus is unique for offering LTVs up to 80%. Their rates vary wildly, from 0% on some short-term products up to nearly 20% on others, with loan terms up to 36 months. The security: Nebeus is registered in Europe and states that most client assets are in insured cold storage. However, regulated in crypto doesn't mean the same thing as a traditional bank, and insurance details matter, so do your homework. Best for European users or those needing the highest LTV possible, as long as they carefully read the fine print on the interest rate. Section 6, the risks. Read this before you borrow. This is a powerful strategy, but don't let anyone tell you it's risk-free. If you ignore the downsides, you're going to get burned. Here are the 3 main risks you must understand. Market risk, the liquidation nightmare. We've covered this, but it's worth repeating. If Bitcoin's price has a catastrophic drop, you can be margin called and liquidated. A forced sale at the bottom is the absolute worst case scenario for a hodler. The best defense is simple: borrow at a low LTV. A 20-30% LTV gives you a massive cushion against volatility. Never take the maximum loan offered unless you are an advanced user who can actively manage that extreme risk. Counterparty risk: the platform goes bust. This is the risk that the company you borrow from fails. We saw this happen in 2022 when giants like Celsius and BlockFi collapsed, taking user funds with them. This is why due diligence is not optional. You have to ask the hard questions. Who is their custodian? Is it insured? Do they rehypothecate your collateral? Platforms that don't rehypothecate, like Ledn and Salt, generally present lower counterparty risk. Also, be aware of withdrawal freezes and sudden changes in terms. They can and do happen. Contract risk: the fine print. You have to read your loan agreement. Is the interest rate fixed or variable? A variable rate can spike, costing you way more than you planned. What's the loan term? Are there penalties for paying it off early? Don't get so excited about the cash that you ignore the contract you're signing. And again, get professional tax advice before you pull the trigger. Look, this can be a revolutionary financial tool. Whether you want cash for a major purchase or you're exploring ways to grow your portfolio, borrowing against your assets is a strategy you need to understand. But the platform and the terms you choose are everything. Do your own research. I put links to the platforms we talked about in the description so you can check their current rates and terms yourself. Don't take anyone's word for it. Verify everything. And if you got any value from this breakdown, do me a favor and hit that subscribe button and turn on notifications. We break down the financial strategies you need to navigate the crypto world and make smarter decisions every single week. The message today is simple, but it changes everything. You do not have to sell your best asset to live your life. The old model of being asset rich and cash poor is over. By using your Bitcoin as productive collateral, you can get the cash you need today while holding on to your vision for tomorrow. You can get the down payment, fund the business, or cover the emergency without paying capital gains and without the deep regret of selling too early. This is the ultimate HODL strategy. It's about shifting your mindset from someone who just owns a speculative asset to someone who manages a sophisticated financial portfolio. Your Bitcoin isn't just something you sit on, it's a tool that can open doors for you. This isn't about being reckless, it's about being smart. By borrowing conservatively, choosing your partners wisely, and respecting the risks, you can build a future where your assets are working for you. You can finally use your Bitcoin without ever having to sell it.